Real estate financial models have a lot of moving pieces. Most real estate pro formas have multiple different tabs that all reference each other, and if one thing gets thrown off in any of these, there's a very good chance it'll end up affecting everything. So to make sure that you are avoiding these situations when you're building and working in real estate financial models, in this video, I want to walk through 4 of the most common real estate financial modeling mistakes that new analysts and investors make, and what to do instead to make your models as accurate and functional as possible. So the first mistake I want to mention here is something that I see a lot, and this is running data tables in a model at all times. A data table is typically used within a pro forma to run a sensitivity analysis, which allows an investor to see the impacts of changes to one or more assumptions in a model all in one place. But while these can be really helpful tools to visualize returns in both a best and worst case scenario at the same time, data tables also require a lot of processing power to run, and if these are recalculating every single time you make a change within a pro forma, this can end up slowing down your model a lot. Now, a good first step to preventing this is to go to File and then Options, and then click on the Formulas tab and make sure that underneath the Workbook Calculation section, the box next to Partial, or in older versions of Excel, Automatic except for Data Tables is selected, and when that's the case, these will only recalculate when a model is saved. But if you're anything like me and you automatically save your work as often as you can, this still won't be enough, and you'll want to actually delete the values inside the data table itself until you've added all of your assumptions and your model is complete. Now, the next mistake I want to mention in this video is another one I've seen a lot throughout my career, and this is adding too many calculations within one individual formula. Especially as you become more comfortable with Excel and real estate financial modeling in general, it can be tempting to try to put together extremely complex formulas for the sake of consolidating all your calculations. But while this can be helpful in some situations, in a lot of cases, this can actually hurt your model down the road. Long and intricate formulas are really difficult to audit, and if another team member needs to update your model, or if you're sending your models off to lenders or equity partners, this makes it a lot harder for someone else to understand your calculations. So to make this easier, instead of packing as much as you can into one single cell, the best practice here is to break these formulas up using what are referred to in financial modeling as helper cells. Helper cells run individual calculations that are used in other formulas in a model, meaning that instead of cramming your operating revenue, operating expenses, and loan payment calculations all in one cell, you would calculate each of these metrics individually, and then you would just reference each of these 3 cells when building out a formula to calculate your cash flow. This makes sure that if you're sending off your model to someone else, they can quickly and easily see where your calculations are coming from. And if you end up needing to troubleshoot any of your formulas in the future, this makes it a lot easier to pinpoint exactly where the issue is coming from. Now, the next mistake I want to highlight here tends to be an issue that comes up for people that are very new to the industry, and this is hard coding numbers directly into formulas. If you're trying to build a model as fast as you can, it can be really tempting to add a growth rate or an interest rate directly into a formula itself, but if you have any intention of making changes to your assumptions at any point, this can end up causing major problems down the line. When you hard code numbers into formulas, every time you need to make a change to the model, you'll need to manually go back and edit every single formula that uses that number, which is not only time consuming, but this also makes it really easy to make mistakes that are really difficult to find. So instead of adding hard-coded numbers into your model, the best practice here is to always use separate cell references for your inputs. So instead of adding your rent growth or interest rate assumptions directly into a formula itself, this would involve creating separate cells entirely to house all of your individual inputs and then referencing those cells directly within your formulas from there. Now, the last mistake I want to highlight here is really important to avoid for a few different reasons, and this is modeling cash flows only on an annual basis. Even though most real estate financial models will include annual cash flow projections, these are almost always based on monthly cash flow projections running somewhere else in the background, which ends up making the annual figures a lot more precise. In commercial real estate, rents are paid monthly, debt service is paid monthly, and almost all operating expenses are also paid on a monthly basis. So if you're building out a model that only includes one cash flow per year, you're missing out on a lot of important details as far as timing is concerned. This is also really important when you're modeling long-term commercial lease cash flows, where things like turnover, downtime, and leasing costs can cause huge fluctuations in your cash flow on a monthly basis, and you need to be able to see exactly when these things are projected to happen to make sure you're prepared. Creating monthly cash flow projections is also really important when it comes to calculating the IRR on a deal, since this is a time value of money metric, meaning that exactly when each of these cash flows is assumed to occur will have a direct and measurable impact on your investment returns. By modeling only annual cash flow projections and using the standard IRR function in Excel, you're effectively running these calculations based on investors receiving only one cash flow per year at the end of each year, which is extremely unlikely in practice. In most cases, distributions on commercial real estate investments will happen quarterly or monthly, and even though this might not seem like a big issue on the surface, the timing of these cash flows can have a material impact on the overall outcome of a deal. For example, if we plan to buy a property in an all-cash transaction for $10 million that would generate $80,000 in operating cash flow on an annual basis, and we plan to sell that property 5 years later for $14 million in an annual cash flow distribution scenario, this would produce a 14% IRR, but in a monthly cash flow distribution scenario, that IRR would jump up by 50 basis points to 14.5%. And while this might not seem like much, if promoted interest on the deal is being calculated based on investors hitting a certain IRR hurdle, which is often the case in real estate partnerships, this can result in a material difference in the cash flows a GP would take home, with a 30% promote over an 8% IRR in this case, earning the GP a little over $1,250,000 in promoted interest in the monthly cash flow scenario, but more than $50,000 less in the annual cash flow scenario just because of the timing of distributions. All of this is to say that even if you want to see cash flows on an annual basis in a model you're building out, you'll almost always want to run your core cash flow calculations directly on a monthly basis within a real estate pro forma. And if you do want to include yearly cash flows in your underwriting, you can then reference these monthly figures within your annual cash flow formulas themselves. At the end of the day, while there's no right or wrong way to build a financial model, these are 4 things to avoid that can make your models a lot less accurate and a lot harder to work in. And if you want to learn more about real estate financial modeling best practices and how to build out a pro forma from scratch in Excel, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more real estate financial modeling related content on the channel, make sure to hit the like button and let me know. And let me know in the comments what other modeling topics you'd like to see covered in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.